Sir, very happy afternoon to all. So we are doing cost of capital. In that we have completed 4 questions out of 7 questions. We are into question number 5. Shall I start the proceeding? Determine the cost of capital of Best Luck Limited using the book value and the market value weight from the following information. So you have to do 2 answers. Book value weight and market value weight. Sir, book value equity share capital 1 crore 20 lakh. Retained earnings 30 lakh. We all know that in market retained earnings will not be there. Market price will be inclusive of retained earning. That's why it is, sir, 2 crores. Preference shares book value is 36 lakhs, whereas market price is 33 lakh 75,000, which is less than the book value. Bad company. Debenture book value is 9 lakh, whereas market value is 10 lakh. Good company. Right, sir? Additional information. Equity. Equity are quoted at 130 per share. Presently, 1 share of the company is selling at 130 rupees. Right, sir? And a new issue priced at 125 per share will be fully subscribed. That means, sir, when you are issuing shares now, it is going to be issued at 125. So 125 will be the market price. So current market price is going to be 125. The old market price is 130. Since you are issuing more number of share, sir, the new shareholders are not interested to buy at 130. They are ready to buy at 125. Will be fully subscribed. Whereas the flotation cost will be 5 per share. So 125 minus 5, 120 will be in your pocket. Alright, sir? So every share will give you 120 rupees, man. Coming to dividend. During the previous 5 years, dividend have steadily increased from 10.6 to 14.19 per share. That means if you see, look back 5 years back, the dividend was 10.6. From 10.6, it has grown to 14.19. So, at some rate, some R, it is constantly growing. We don't know what is the growth rate, so we have to find out by using the interval between the dividend. Dividend at the end of the current year is expected to be 15 per share. So, after this year, after the end of the 5th year, that is the DPS 1 is going to be 15. So, this data I can use to find out the G. So, G I can find out by using the difference between 10.6 and 14.19. Preference shares, 15% preference shares with face value of 100 would realize 105 per share. So, KP is equal to 15% is a coupon rate. But we have to calculate the KP that we will be calculating. Debenture, company proposes to issue 11 year. So, it's a redeemable debenture. 15% debentures, but the yield on debenture of similar maturity and risk class is 16%. Flotation cost is going to be 2%. Fantastic, sir. Corporate tax rate is 35%. Ignore dividend tax. Flotation cost should be calculated on the face value and not on the issue price they are highlighting. It's one of the good question available in the ICI book back. Good question according to me. First, you have to calculate each and every component of cost of capital. Like KE, KP, KD and KR, it is given in the question because retained earnings are also there. And we have to calculate 2 times, man, with book value weight and market value weight because they want different cost of capital. Listen along with me, get the maximum explanation how you have to proceed to the question. We all know that KE is equal to DPS 1 divided by MPS 0 plus G. Actually, G is missing in the question. In every question, they would have given G. But now, they are asking us to find out the G. G means growth rate. Right, sir? So, I am going to calculate G. But they said that this is a timeline they are talking about. In year 0 and year 5, my dear lovable students. In year 0, that is 5 years back, the dividend was, how much you know, 10.60. 10.6. So, this 10.6 have grown, that is plus G, and it has reached to 14.19. 14.19. Actually, here we have to use the concept of compounding. What concept? Compounding, not the discounting. Not the, because 10.6 has been grown, grown for 5 times. And after 5 years, it has become 14.19. As we all know that, sir, future value is equal to present value into 1 plus r raised to n. Right, sir? They have given future value as 14.19. That should be equal to 10.6 into 1 plus r, only God knows, sir, raised to 5 years. Because 10.6 is growing at some rate. 10.6 is growing at some rate and it has reached 14.19. So basically 10.6 into 1 plus r raised to 5 is equal to 14.19. I want 1 plus r raised to 5 is equal to 14.19 divided by 10.6. So that means, calculator man, 14.19 divided by 10.6 comes to 1.338. 1.338. You know what is the interpretation of this? If you understand interpretation, you can find out the answer like this. Today's 1 rupee is equal to 1.338 rupees after 5 years. Today's 1 rupee is equal to 1.338 rupees after. So I don't know what is the growth rate, compounding rate. So trial and error method you have to do. So in trial and error method, I am taking 3%. I don't know, man. I am taking how much percent? Some percent I am taking. 3% I am taking. Okay. So, sir, the 3% means it will be 1.03. Right, sir? 1.03 into 1.03 into 1.03 into 1.03 into 1.03. Calculator, take and tell me how much. 1.159. I don't want 1.159. I want 1. So I am putting 4%, just trial and error. 1.04 into 1.04 into 1.04 into 1.04 into 1.04 comes to 1.265. I don't want 1.265. I need 1.338. Right, sir? So 5%, 1.05 into 1.05 into 1.05 into 1.05 into 1.05 comes to 1.276. I don't want 1.276. I want 1.338. So 6%. 1.06 into 1.06 into 1.06 into 1.06 into 1.06 comes to 1.338. Look at what is the number. 1.338. Are you all really with me? That means, my dear lovable students, growth rate is exactly 6%. Sir, sometimes the future value table will be given in the question. If future value has been given in the question, then no problem. Hello, sir. We can find out easily 1.338. Otherwise, this is what happening in the future value table. Comfortable? I started with some 3%, then it has not worked. 4%, not worked. 5%, not worked. 6%. Comfortable? In examination, they will give the present value factor, present value table and the future value table. So it's very easy, man. So now I am going to replace the things here. So KE is equal to DPS1 already given in the question as 15%. How much? 15 rupees. Because the next year, look at the wordings, man. Look at the wordings, man. During the previous 5 years, dividend have steadily increased from 10.6 to 14.19. So 10.6, it is growing at 14.19, means the growth rate is 6%. If you want any doubt, take calculator. 10.6 into 106% you put. How much you got? 11.236. That means it has grown for 1 year. Again into 106% you put. How much you are getting? 11.91016. So second year grown. Into 106%. 12. Third year it has grown. Into 106%. 13.38. Fourth year grown. Into 106%. 14.185, which has been grown to 14.19. Fantastic to the core. Our growth rate is exactly 6%. Compounding rate, are you able to appreciate? Super, sir. So dividend at the end of the current year is expected to be how much, man? 15%. Are you really with me? So current year there is a, sir, a DPS1 is going to be how much, man? 15. If you want, sir, 14.19 into, again put 1.06. 1.06 comes to 15.04. No one will give the dividend like 4 paisa and all. So they have round off to how much, man? 15 rupees. Very comfortable. Every data in the question is matching. Super, super fantastic question. So 15 rupees is going to be the DPS 1. Tell me what is going to be the MPS 0. Today the current market price of the share is 125. But is there any flotation cost? How much flotation cost? So minus 5. Plus just now you find out 6% is the growth rate. Comfortable, sir? So basically, technically 15 divided by 120 plus how much percent? 6%. So 15 divided by 120, sir, into plus 6% comes to 18.5% is what the KE is. What the what? KE. So shall I go through? Shall I check whether our KE is right or not? Look at here, man. This is the answer from ICI. Question number 5. Cost of equity KE is equal to DPS 1 divided by MPS 0 plus G, which is 15 rupees already given in the question. 125 minus 5 plus 6%. That means our growth rate is 6%. No need to check because every angle we have checked. Right, sir? So KE is equal to 12.5 plus 6% comes to 18 point. They have calculated the parlay G plus G. That means, sir, 10.6 have grown at some rate for how many years? 5 years. And it has grown to 14.19. So 1 plus G raised to 5 is equal to 14.19 divided by 10.6 comes to 1.338. This is what I have interpreted at 1 rupee today is equal to 1.338. After how many years? So it has grown at some rate. Is this discounting or compounding? Compounding, because in capital budgeting we are using the technique of discounting, but this is that sir, compounding, right, sir? So table, sir, future value, not the present value. In discounting we will use the present value table, whereas in compounding we will use the future value table, because I am having already present value. I have to reach the future value, so I need the future value table, not the. I will show you both present value and future value table. Give me some time. Okay. Suggest that 1 compounded to 1.338 in how many years? Exactly my explanation. Today's 1 rupee will become 1.338 rupees after 5 years. At the compounded rate of how much percent? Therefore, G is equal to how much percent? 6%. Comfortable? So, we also got 18.5%. Super, sir. KE itself, this much working is there. Fantastic, sir. Now, coming to, sir, KR, cost of what earning? Retain earning. Is there any flotation cost in the question? Yes, sir. There is a flotation cost of 5 rupees. If there is flotation cost, KE is not equal to KR. Right, sir? That's what you have to write first. Since flotation cost is there, KE is not equal to KR. Because the denominator will change. The denominator will not be 120. Denominator will be 125. Denominator will be 125. Right, sir? So, KR is equal to DPS 1 divided by MPS 0 plus G. Already G we have find out. How much percent? Tell me what is DPS 1? 15 divided by MPS 0 is 125. No need to spend flotation cost. Right, sir? Plus 6% basically technically. So 15 divided by 125% will be 12. 12 plus 6 comes to 18%. Are you really with me? Look at the logic. Look at the logic. You know what the logic is? KE is equal to 18.5% because for KE we have to spend the flotation cost. Since we are spending flotation cost, it will be a cost to the company. Automatically the cost to the company will be more. Right, sir? Whereas KR does not have the flotation cost. That is why it is 18%. Comfortable? Always KR will be less than the KE because KR is an internal source of finance and KE is an external source of finance. KE is a most costlier source of finance and KR is the little cheaper source of finance as compared to KE. Because of the villain, that is flotation cost. Very logical discussion. Comfortable? Fantastic to the core. Sir, coming to the next one. So, I'm just checking the answer, man. Cost of retained earnings, which is nothing but KR is equal to DPS 1 divided by MPS 0 plus G. 15 divided by 125 plus comes to 18%. Even I have compared the reason for the differences also. Are you clear? I'm going to compute the sir cost of preference shares, which is nothing but KP. Sir, KP is equal to PD divided by NP into 100. Right, sir? They themselves given as PD. PD is going to be 12% because if the face value is how much percent? 100, 15 percentage. PD is going to be 15 percentage because if the face value is 100 rupees, 15 percentage is what? The preference dividend, right, sir? And always we have to pay the preference dividend on the what value? Face value. How much is the face value? 100. Would realize how much per share? 105 per share. So PD 15 divided by 105 into 100. You tell me, sir, here they have said that the flotation cost will be how much per share? 5 per share. For equity, they have attached the flotation cost. For debenture, they have attached the flotation cost. That means flotation costs are specific and not general. That means for preference share, you are not supposed to reduce the flotation cost because in every point, wherever they need, they are saying there is flotation cost. If the flotation cost has been given here, then I would have reduced even the flotation cost for the preference shares also. Very comfortable, sir. So, my dear lovable students, this calculator will say the answer, nothing is there. 15 divided by 105 into 100 comes to, so KP is equal to 14.28 or 29 percentage. 29 also if you want, you can go 29 percentage. Sir, this is what? 14.29 percentage. Comfortable? Fantastic to the core. Sir, somehow we have crossed the KE, we have crossed the KR, we have crossed the KP. Now I am moving into the, sir, KD, the hero of the question. Fantastic, sir. What the KD is saying, company proposes, even company started proposing. Super, sir. To issue 11 years. 11 years. How many years? 11 years. 15% debenture. Fine, sir. So this is not a irredeemable debt. This is a, okay, man. Since this is a redeemable debt, so I into 1 minus 3 plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Yes, sir? Fantastic, sir. Good rhyme, sir. Okay, sir. Sir, for KD, they are going to pay 15 percentage. So it is already given in the KD I have find out. So KD is equal to 15 into 1 minus 1 is 1. If you don't know anything also, we can write 1. Fantastic, sir. Tax rate given as 35 percentage, which come to 0.35 plus RV means redemption value, right, sir? Redemption value means they said that company proposes to issue how many year? 11 year, 15% debenture. Okay, they are going to issue 15% debenture. But the yield on debenture, the return on debenture on the similar maturity and the risk class is how much percent? Basically, they have not mentioned anything about the redemption value. If nothing has been mentioned regarding the redemption value, you have to take it as par. That means 100 rupees, right, sir? But today, net proceeds, they have nothing mentioned about the what proceeds? Net proceeds. That means if they issue one debenture, what is the current market price? Nowhere they have discussed, right, sir? But they said one thing, just listen, pin drop silence. Sir, the company proposes to issue how many year? How much percent debenture? But the yield on debenture of the similar maturity, that is, if some other person is issuing, some other company is issuing the similar type of debenture for a life of how many years? And the risk class will be how much? That means, my dear lovable students, hello, sir, you will be getting a, just wait it, net proceeds, you will be getting 15 rupees. You will be getting, because face value is 100 rupees, 15 percentage is the interest, right? With an expectation of 16 percentage. Are you really with me? So 15 divided by 16 percentage means the net proceeds is equal to 93.75. So whoever want, for example, sir, I don't understand anything, sir. Just listen here. Sir, I need, sir, 15 rupees. I need 15 rupees as my return. I need 15 rupees as my, you need interest of 15 rupees. Okay. And your expected return is 16 percentage. And your expected return is, what is the capital is a question. So you will pay something, no. On that something, if you apply 16%, you should get the answer as 15%, 15 rupees. So that is a question. Hello, sir. So what is the principle is the question. Hello. So if I give today 93.75, take the calculator. What is, this is the amount you are going to invest today. What is your expectation? 16%. So into 16% means 15. Very good, sir. Congratulations, sir. This is how you have to interpret that line. Come on, come back. Sir, what they are saying, the company proposes to issue 11 year, 15% debenture. But the yield on debenture of similar maturity and the risk class is 16%. Hello, sir. That means their expectation is 16%. So I need 15 rupees. This 15 rupees should be 16%. That means for that, I should invest 93.75. Right, sir. So the debenture holder will be ready to give me 93 point. But that 93.75 I can't enjoy. Less flotation cost. Flotation cost should always calculate on 2 rupees will go as flotation cost. So 91.75 will be the net proceeds. Very good, sir. Congratulations, sir. Hello, sir. So RV redemption value is going to be 100, whereas my net proceeds is 91 point. This I have to write off over a period of 11 years. Divided by redemption value 100 plus 91.75 divided by 2 will give the average liability. So 15 into 65% comes to 9.75. You are having a capital loss 100 minus 91.75 divided by 11 comes to 0.75 divided by 100 plus 91.75 which is 191.75 divided by 2 comes to 95.875. Right, sir? So 9.75 plus 0.75 comes to 10.5 divided by 95.875 into 100. So 10.5 divided by 95.875 into 100 means KD is equal to 10.95% is the cost of debt. I'm checking, man. My KD, my cost of debt is 10.95%. We also got the 10.95%. Very comfortable. That's what they also have done. I into 1 minus C plus RV minus NP divided by N whole divided by RV plus NP divided by 2. In that I already given in the question 15. 1 minus tax rate is 35%. 100 is the redemption value. Nothing has been given in the question. So we have assumed that they are redeemed at par. Plus 91.75. How you are getting 91.75, which is nothing but the debenture holders wants a return of 15 rupees with an expected rate of 16%. So it is going to be 93.75. From that the company is supposed to pay a flotation cost of 2 rupees. So 93.75 minus 2 rupees will give you 91.75. Very good. So there is a capital loss that has to be written off over a period of 11 years. So the average liability will be 100 plus 91.75 divided by 2. Right, sir? So if you calculate then, sir, 10.95. Since yield on similar type of debenture is how much percent? 16%. The company would require to offer debenture at a discount. Because for others, their requirement is 16%. The other debenture holders in the market are expecting 16%. But our debenture holders are expecting only 10.95%. So our company is giving less KD. Hello, sir. Whereas the market is giving more KD. Comfortable? So market price of the debenture by approximation method 15 divided by 16% come to 93 point. Sale proceeds from debenture 93.75 minus 2, that is flotation cost. So 91.75. Very comfortable. The same thing you can find out using YTM method also. YTM method also. Yield to maturity. Because value of an asset today, that is what missing. Value of an asset today. Sir, as per YTM, value of an asset today is equal to present value of its future cash flows. Right, sir? What are the cash flows you are going to get? You will be getting 15 rupees as dividend. Yes, sir. For how many years? 11 years at the rate of 16%. Comfortable. Plus on the 11th year, you will be getting 100 rupees as repayment. Yes, sir. At the rate of how much percent? 16%. Can you take the calculator? 1 divided by 1.16 16% is equal to put a GT and tell me what is the cumulative present value factor at 16% for 11 years. You tell me what is the answer. 5.029. Shall I take 5.029? Plus, once again, on 11th year, at the rate of 16%, what is the present value factor? 0.195. Can you take the calculator once again? Sir, 5.029 into 15 rupees every year comes to 75.435. Hello, sir. Plus 100 into 0.195 comes to 19.5. 19.5 plus 75.435 comes to 94.935. Right, sir? Yes, sir. Here we got 93.75. Here we got 94.935. Hello, sir. From this, there is a flotation cost of how much rupees? 2 rupees. That always has to be reduced from the face value. So 94.935 minus 2 rupees comes to 92.935. Look at here. Here you got, sir, 91.75. There will be light difference because here you are taking not the full amount. Hello, sir. So by YTM also you can solve this question. That is also possible. That is what they have explained here, my dear lovable students. You can go through it, the same what I have solved, the same thing they have explained. Okay, sir. Fantastic, sir. Now I am going to calculate the WACC using the book value weight and market value weight. You tell me, sir, WACC means, sir, number column should be there, right, sir? Source should be there, right, sir? Amount column should be there, yes, sir. Proportion should be there, yes, sir. Individual cost of capital should be there, and WACC should be there. Right, sir. Look at the question, man. Look at the question. What are the sources, man? Number 1, 1, 2, 3, 4. Number 1, equity share capital. Right, sir. 2, reserves and surplus or retained earnings, whatever it may be. 3, preference share capital. 4, debentures. Fantastic to the core. Sir, say only the book value, man. Don't go to the market value. Okay. Equity, how much, man? 1 crore 20 lakhs. Reserves and surplus 30 lakhs. Preference 36 lakhs. And debenture 9 lakhs. Can someone say the total of all of that? 1 crore 95 lakhs. 1 crore 95 lakhs. Shall we calculate the proportion? Calculator, man. 120 divided by 195 into 100 comes to, it is coming kachaka mucha. I don't want kachaka mucha. So 120 divided by 195. 30 divided by 195, 36 divided by 195, 9 divided by 195, and here total dash, or you can put 100, or you can put 1. Right, sir? Sir, for this only, ivlo poratam. What? KE, KR, KP, KD. Correct? What was the KE? 18.5%. What is KR? 18%. What is KP? 14.29. Just now we find out KD. 10.95, right, sir? So calculator, man, 18.5 into 120 divided by 195 comes to 11.38%. 18 into 30 divided by 195 comes to 2.76777, whatever it may be. 14.29 into 36 divided by 195 comes to 2.64. Okay, fine. Dharala Prabhu. 10.95 into 9 divided by 195 comes to 0.505. That means 11.38 plus 2.77 plus 2.64 plus 0.505 comes to 17.295. 17.295. Basically 295 means basically 30. Is what the KO if you are taking what value weight? That's what, man. 17.29 is the KO using book value weight. Very comfortable? Yes, the same thing we have to repeat, man, for the market value weight. What value weight? Market value weight. Shall we? Yes, imposition, man. Again the same column. The number column. Number 2 is what? Source column. Number 3 is what? Amount column. Number 4 is what? Proportion column. Number 5 is what? Individual cost of capital. And number 5, WACC. Are you all really with me? 1, 2, 3, 4. Comfortable? So you tell me, man. The first one is equity, right, man? Second one is reserves and surplus. Third one is preference. And fourth one is debentures. Sir. This is market value weight, sir. Why are you writing reserves and surplus, sir? You have to write a dash, sir. I would have put a dash if KR is equal to KE. Here KR is not equal to, then mandatorily you have to apportion this 2 crore in the ratio of this book value. Hello, sir? Because KR is not equal to KE. Like this one question is more than enough. Right, sir. Sir, apo 2 crore into, sir, 2, 4, 6, 7 into 120 divided by 150 comes to 160 lakhs. 160 lakhs is the equity and 40 lakhs is the reserves and surplus. Preference they have given, man. Don't do apportionment and all. Yes, sir. So 33 lakh 75,000 is with regard to preference and 10 lakh 40,000 is with regard to debenture. Comfortable, sir? Sir, proportion, you tell me what is the total market value of the firm as a whole? 2 crore 44 lakh 15, yeah, 15,000. Kandipa, it will be kachamucha. Yes, sir. So, nothing but man, sir, very simple. 1 crore 60 lakhs divided by capital employed. Capital employed means total. I don't have space, that's why. Sir, 40 lakhs divided by capital employed. 33 lakhs 75,000 divided by capital employed. 10 lakh 40,000 divided by capital employed. And here it will be 100. Very good, sir. Now, you should be very clear, sir. This is going to be, first you have to write payee, then KR, then KP and KD. Right, sir? Tell me, sir, what is KE? 18.5%. Here it is going to be 18%. KP? 14.29% and KD 10.95. Good boy. Calculator man. 18.5 into, sir, 1 crore 60 lakhs. 1 crore 60 lakhs divided by 2 crore 44 lakh 15,000 comes to 12.12345 Okay, percentage. Fantastic, sir. The next one. 18 into 40 lakhs divided by 2 crore 44 lakh 15,000 comes to 2.949%. Very good. Congratulations. 14.29 into 33 lakh 75,000 divided by 2 crore 44 lakh 15,000 comes to 1.975%. Right, sir? Sir, 10.95 into, sir, 10 lakh 40,000 divided by 2 crore 44 lakh 15,000 comes to 0.466%. So now what? Oh, 12.123 plus 2.949 plus 1.975 plus 0.466 comes to 17.513. Here it is 17.29. Whereas the KO as per market value weight is 17.51. We also got 17.51. We extended to one more decimal, 513. My dear lovable students, with this we can say that we are through with question number 5, one of the most important question. I hope that every logical aspect has been discussed in the question. Are you clear with question number 5? Yes, then redo question number 5. Try question number 6 and I will be doing question number 6. Then check the answer for question number 6.